Okay, I think we are back. I think we are back. It could be that we didn't have connectivity before, but it should be that now we have connectivity. Okay. We are back. We are back. I hope you guys can see me. I hope you guys can hear me. I just had to disconnect and then reconnect, and now I'm back. And I think that you guys are here as well. So hopefully you could see me. Hopefully you could hear me. And if you could see me and if you could hear me, just let me know in the chat box. Okay, it looks like people can see me here. Fantastic, fantastic. Yes, okay, so we are in business. Sorry for that little delay, but I know everyone is urgently waiting how to save on their taxes this year and also in years going forward. So this is going to be a pretty juicy class. Let me just remind everybody that these classes, they do not happen in a vacuum. They happen because I have people supporting me. I have my clients, I have my members, people who are keeping me in business. And if you know somebody who's a client or a member, can you please give them a hug for me? And if you would like to become a client or a member, I'm going to show you how in just a second. On the side, you guys may see, I have just now opened up a button on the side of the screen, and that button takes you to a web form where you could request to meet with my team if you're interested in working together and doing any form of planning for your retirement, planning for your federal benefits. And today's conversation is going to be about tax and tax planning. So it's going to be pretty relevant to you guys as well. So whoever's interested in meeting with myself, meeting with my team, just click on that link and you will be taken to a web form. And on that web form, you can leave your contact information so we can reach out to you and get started meeting with you. Okay, fantastic. And without further ado, let us move into today's topic, which is going to be 5 tax tips, things you could do to lower your taxes this year. I know it's very exciting. It's very exciting, but are you sure you want to lower your taxes this year? Is that something you really want to do? Maybe before you do your tax savings for this year, maybe you should do some tax planning. I don't know if you guys have ever heard of that before. What exactly does that mean, tax planning? So tax planning is basically a way of broadening your perspective. The perspective that most people have is, what can I do to save taxes now? What I would like you to do is, I'd like you to think about, is it worth it to save the taxes now, or am I better off saving the taxes later? So what tax planning does is it just broadens your perspective. Instead of looking at this year in isolation, we are now looking at it in a broader spectrum. It's not just this year we're concerned about, we're also concerned about the future years as well. And I have a slide over here, and we're going to go through some of the obvious benefits of reducing your taxes now, but some of the less obvious benefits of not reducing your taxes now. Okay, so let's talk about some of the benefits of reducing your taxes now. So the first obvious benefit of reducing your taxes now is you have more money in your hands now. Obviously, hello. This way, you have more take-home pay. You have extra money to spend on all the fun things and all the wonderful stuff you want to do. So obviously, lowering your taxes now is an obvious, tangible benefit that we could see and feel and enjoy right away. That's obvious. There are other benefits to lowering your taxes now. Eligibility to make IRA contributions. So for those who don't know what I mean, if you want to contribute to an IRA, forget about the TSP for a second. I'm talking about an IRA. If you want to contribute to an IRA, there are income limitations, meaning if you are making too much money, you will either not be able to contribute to the Roth IRA, or on the traditional IRA, you might be able to contribute, but you might not get the tax deduction. So if you're making too much money, you might not be able to contribute to these Roth or traditional IRAs and get the benefits. And if we could somehow lower your income, that will then open up the possibility for you to be funding your Roth IRA and traditional IRA and getting the tax deduction outside. So by lowering your income, you open up your ability to participate in IRAs. The list goes on. Student aid eligibility. If anybody here has ever applied for student aid, you know that one of the things they're looking into. So whether you're applying for your children's college education or whether you're applying for your own, right? If you're applying or your kids, forget about just college education, any education. So if you're applying for student aid, they are not just looking at the child's income, they're looking at the parent's income as well. So if you're making X amount of money, you're not going to be eligible for student aid. And again, that's going to vary. However, if we could somehow lower your income, then you may become eligible, or your child may be eligible for student aid. Fantastic. So that's a justification to lower your income. Also, next on the list, there are some student loans where the repayment is based upon your income, meaning the more money you're making, the more you have to pay back towards your student loans. The less money you're making, the less money you have to pay back towards those student loans. So obviously, if we could somehow lower your income, that will have you pay back less on those student loans, at least on a monthly basis. And it's especially sweet if your student loans are scheduled to be forgiven after, 10 years of public service or whatever it may be. Last on the list, there's the deductibility of student loans. So anybody here is paying student loans with interest. Is that interest deductible? And the answer is it's deductible, but only if your income is below a certain level. Once you go beyond that level, your interest is no longer deductible. So if we could somehow lower your income, that makes that student loan interest deductible. So there are clear benefits to lowering your taxes now. However, one of the reasons why you're here is not just to hear how to lower your taxes now, but also let's consider whether it's worth it to lower the taxes now, because there are some drawbacks. By you lowering your income today, believe it or not, there's a little bit of a gotcha. You lose some benefits. So here's some of the drawbacks on the right side of the slide. Here's some of the drawbacks of reducing your taxes now. The first is you have less post-tax dollars in the future. Meaning, I know that if you lower your taxes now, you have more post-tax dollars now, but you have less, or you have more take-home pay now, but you'll have less take-home pay in the future. Let me explain what I mean by this. So if anybody here is investing in the TSB, I'm sure you know that the different funds in the TSB, some of them have relatively high returns, some of them have relatively low returns. Let's use the C fund. The C fund is a great example. So the C fund, S&P 500, I'm sure you guys have watched the performance of the C fund for the past 10, 20, 30, 40, 50 years, right? The C fund the S&P 500 has been around for a long, long time, even before the TSB came into existence. And does anybody here know what has been the return of the C fund for the past half a century? So ballpark about 10%. Now, obviously, it's not always 10%. Sometimes it's a negative year, sometimes it's a positive year. But over the long term, the yield of the C fund has been 10%. Please tell me, is that a net 10% or is that only a gross 10%? And the answer obviously is it depends whether you are contributing to your traditional TSB or your Roth TSB. If you contribute to your traditional TSB, you will have lower taxes now, but you're going to owe the taxes on that money later. So even if your TSB grew with a 10% return, that's only a gross 10% in your traditional. After taxes, you're going to be left with less than 10%. It might be 8% or maybe even closer to 7%. So if you're getting a 10% yield in your C fund in your traditional TSB, you're grossing 10 but netting only 7. As opposed to in the Roth, with your Roth, you're not just grossing a 10, you're netting the 10. So even though the Roth did not reduce your taxes now, but it did reduce your taxes later. Okay, and that's going to be a subject for a different discussion. We're not going to get too deep into that right now, but just so you know that in general, I encourage people to be contributing to the Roth. Okay, the next bullet point on the right side of the slide. The money becomes temporarily inaccessible. So obviously, if you're putting money into certain instruments, whether it's a traditional TSB or an HSA or your college savings, right? So obviously, you do have the ability to reduce your taxes, at least when it comes to the traditional TSB and the HSA. The college, you might get a little bit of a tax break in the state level, right? So you did get a slight tax benefit this year where you reduced your taxes. But remember, that money is now tied up. It's now inside a retirement account. You have to wait till 59 and a half. Or the HSA money could only be used for medical expenses, and the educational money could only be used for education. So obviously that money is no longer accessible. Third on the list, that if you're trying to reduce your taxes now, that's a great thing. You're going to lower your taxable income. That sounds wonderful. However, if you try to get a loan, and you show that you now have a reduced income because you wanted to reduce your taxes, well, you might not have the same borrowing power. If a person was making $100,000 a year, as opposed to a person who's making only $75,000 a year, their borrowing power is very, very different. Next, a possible reduced Social Security benefit in the future. Now, this is usually not that big of a deal, but some of your federal benefits are lowering your income, which in turn will lower your future Social Security benefits. So, for example, your FEHB premiums, right? So lowering your taxable income, taxable for FICA purposes, FICA meaning Social Security, Medicare, the employment tax. So if you have those federal benefits that lower your taxable income, your FICA income, that is going to lower your future Social Security benefit. I'm not talking about lowering it by a massive amount, but it's still going to give you a lower future benefit in the future. Same thing with your HSA. If you contribute to your HSA and your FSA, that lowers your FICA, that lowers the amount of income that you're going to be paying Social Security tax on. And as a result of lowering that income, you're going to have a lower Social Security benefit in the future. Now, what I just said about lowering your Social Security benefit in the future, that's really not relevant for anybody whose income is above the Social Security cap. So if you're making above the Social Security cap, which this year is like 174, 176, whatever the number may be. So if you're making above that, so then, even if you contribute to your HSA or FSA or FEHB, you're probably not going to really lower your Social Security benefits much. But if you're making below that 174, then that's going to translate into a reduced future Social Security benefit. Next on the list, higher RMDs in the future. Okay, meaning, yes, by you contributing to your traditional TSB, for example, you lowered your taxable income right now, but do you know that in the future you have mandatory distributions, and those mandatory distributions are a percentage of your traditional account balances? Meaning there's no forced distribution from your Roth TSB or Roth IRA. There's no forced distribution from your brokerage, non-retirement, non-qualified investments. There's no forced distributions, but from your TSB and from your traditional IRAs, there's going to be a forced distribution. And that forced distribution may actually push you into a higher tax bracket. It may push you into a higher tax bracket, and also it may push your surviving spouse into a higher tax bracket. So I don't know if you guys know this, but let's say you have a married couple. So, and their combined income is, let's just say $300,000. Okay. So if they have a $300,000 combined income, they're probably going to be in the 24% tax bracket. That's because there's two spouses. But let's say one of the spouses passed away, and now there's only one spouse left over. And that spouse has an income of $300,000. Now, why would they have an income of $300,000? Because it could very well be that when the first spouse passed away, the first spouse left behind their traditional TSB, their traditional IRA, their traditional investments, and the surviving spouse, they may have their own TSB, their own IRA, their own traditional investments. So this surviving spouse now has two investment accounts, and when they reach the RMD age, which for many people is age 75, they're now going to have to take an RMD based upon both of those account values. So it could very well be that the RMD of their own account might be approaching 100,000, and the RMD of the deceased spouse's account may also be approaching 100,000. And then they have their own pensions and social securities or whatever they maybe have. So that means their income as just a single person, they survived their spouse. They're now a single person. They're now 300,000. They're going to be in the 32 tax bracket, or maybe even the 35 tax. I have to remind myself which bracket they're in, but they're going to be in a higher tax bracket. So believe it or not, by you leaving them, by you avoiding the taxes now, you left them your traditional TSB, which they have not paid tax on. They're going to have mandatory distributions, which again is going to push them into higher tax brackets as well. So it's not just you being pushed to high tax brackets, but very likely your surviving spouse could be pushed to even higher tax brackets. Second to last on the list, on the right-hand side, no stepped up basis later. So I don't know if you guys know this, but when you have a non-retirement account, like a brokerage account, a non-qualified account, so the growth in that non-qualified account passes to your heirs tax-free, but only if you put that money into that non-qualified account. So for example, if you put your money into a traditional TSB and you pass away and the money goes to your heirs, that is not going to be tax-free. That is not going to be tax-free at all. But if you have a non-qualified account, as a result of having that money in a non-qualified account, all the unrealized gains get passed to your heirs with zero tax. It's a stepped up cost basis and there's zero tax to them. So you could have left them zero tax on the gains, but instead, by you doing your traditional tax, your traditional TSB, you're right, you lower taxes now, but you ended up leaving them with a massive tax liability later. And by the way, on this topic, I don't want to get too deep into this, but something that I encourage people in this class to look into is when you're positioning your investments. So some of you have traditional money, some of you have Roth money, some of you have non-qualified money. In my mind, the way you position that money, the traditional, the Roth, the non-qualified money, is very, very different from each other. So for example, the Roth and the non-qualified money, I usually like to have my growth-oriented instruments in those accounts. This way, all the growth is either tax-free in the Roth or tax-free with the stepped-up basis in the non-qualified accounts. So if I'm having tax-free growth, what type of growth would I like to have in that account? Would I like to have itty bitty, G fund or CD growth? No, I want to have C fund growth in those accounts. If you're going to have traditional accounts, that money is going to be taxed. So there, I don't necessarily need as robust growth. I can have, modest growth. My point is that if you in your portfolio have some of your money which is growth oriented and some of your money conservative, there actually is a rationale. There's a line of logic that says that the growth-oriented money should be in the Roth and the non-qualified, and the non-growth-oriented money, the conservative money, should be in the traditional. This is just, being aware of the tax consequences, not today's tax consequences, but the future tax consequences. And then last on the list on the right-hand side of the slide, increased Medicare Part B premiums. Now, for anybody who's been to a class of mine before, you may remember that I don't push Medicare Part B. Medicare Part B is something that is optional. You do not need to have it. I know Medicare is going to threaten you. They're going to send you the death threats in the mail. My clients show me the letters. I know it's very, very pushy. They're a big bully. But I don't push my clients to have Medicare Part B because I usually find that FEHB alone or FEHB and Medicare Part A usually sufficient. But with that being said, anybody here who's going to have Medicare Part B, your Part B premiums are based upon your income. And in retirement, you may think your income is going to go down, but let me remind you of those mandatory distributions. Those mandatory distributions are probably going to push your income up. Even if it doesn't push you into a higher tax bracket, but it may push you into a higher Medicare bracket. Medicare brackets and the tax brackets are not the exact same thing. So if you have those mandatory distributions, which are going to be coming from your traditional accounts, and why did you put money into traditional accounts? Because you wanted to save taxes now, right? Yes, you're right. You save the taxes now, but then you have future RMDs. Those future RMDs are going to bump up your income. Now you're going to be in a higher Medicare bracket. Now your Medicare premiums are going to increase hundreds of dollars each month per person. So I'm hoping you guys are noticing that when it comes to saving and taxes, I know it feels good to save taxes now, but it also feels good to save taxes later. And sometimes it even feels better and stronger when you see the ripple effect, the consequences. So what I'm trying to say is, don't necessarily be in a rush to save the taxes this year. Broaden your perspective and see if you could compare the tax benefits this year versus the tax benefits in the future. Now, with that introduction in mind, I'm going to show you how to save taxes this year. Again, with all these tax tips, I'm going to share with you guys five tax tips to saving your taxes this year. With all of them, I remind you, yes, you're going to save taxes this year, but be aware there might be a trade-off. You might end up owing more taxes in the future, either you or your heirs, your survivors. And there may be other ripple effects, which is that you may have a smaller Social Security benefit in the future, as well as you may have your increased Medicare Part B premiums, as we mentioned just a second ago. I had to remind myself. Fantastic. So with that being said, let's talk about ways you can save in taxes this year. Here we go. Number one is obvious. Max out your pre-tax traditional retirement accounts. That is obvious. That is obvious. As we said, if you put your money into your traditional TSP, traditional IRA, it will lower your taxable income. You will have more take-home pay today. Yes, you will. Yes, you will. Okay. And when I say max out, so I'm sure you guys know that there is the regular contribution in the TSP, and then there is the catch-up contribution in the TSP. However, did you hear about the new and improved catch-up? Believe it or not, there is an additional catch-up for people that are age 60 to 63. This is pretty brand new. Okay, pretty brand new. So if there's anybody in this class that is age 60 to age 63, you could do an additional catch-up contribution. Okay, if you guys want, you can look into how much that additional catch-up contribution is. But my point is that anybody here who wants to do regular TSP contributions, so you can do regular TSP contributions at $23,500. Once you reach the year that you turn age 50, you could do an additional catch-up contribution. And then once you reach the age of the year that you turn age 60, 61, 62, 63, just those 4 years, you could do an additional catch-up contribution. Okay, so you guys could look into that and see whether you are able to make those contributions this year. That is number one. Number two, max out your HSA or your FSA or your Lex FSA. For those who have come to previous classes, you may know I am a very big fan of the HSA. The HSA allows you to avoid the taxes now and later if you use it for medical expenses. The same thing with the FSA and the Lex FSA. It allows you to avoid the taxes both now and later. So that is fantastic. That means you're not deferring your taxes later. You're literally avoiding those taxes. And by the way, if you add up the taxes, you're saving federal tax, state tax, Social Security, Medicare tax. If you add those things up, federal tax is your top tax bracket, some of you in the 24 bracket. State tax, that obviously depends which state you live in, let's say 6% for state tax. Social Security tax, 6.2. Medicare tax, 1.45. That's 37.65% tax savings. That is fantastic. Now, in order to have an HSA and a Lex FSA, you need to have a high deductible health insurance plan. I'm not going to get into that conversation right now. That is definitely a conversation for a future class. I would tell you guys to join my email list. If you're not on my email list yet, you should definitely join my email list so you could be informed about that upcoming class about the open season, health insurance decisions, HSA, FSA, Lex FSA. That is important. But in order to have an HSA and Lex FSA, you must have a high deductible plan. And for those who have been to my classes, you probably know I would probably encourage you to have a high deductible plan. For most people, it works out in their favor. Okay, that's tax tip number two. Tax tip number three, realize your losses in your non-qualified accounts. Now, nobody likes losses. I get it. But if you had a loss, can you benefit from a loss? And the answer is, it depends where that loss takes place. If you have that loss inside your traditional TSP or your traditional IRA or your Roth TSP, Roth IRA, no, you cannot benefit from that loss. However, if you have that loss in your non-qualified account, which is some people call it a brokerage account, other people call it their non-retirement accounts. If you have a loss in your non-qualified accounts, you could use that loss to reduce your taxes. So, for example, if anybody here has a realized gain and you also have a realized loss, well, your losses can offset your gains. Fantastic. So, for example, if you have 10,000 gain, 10,000 loss, those 10,000 loss could offset the 10,000 gain. This way you won't have to pay taxes on that $10,000 gain. Fantastic. Or let's say you didn't have any gain. All you had was a $10,000 loss. Okay, you could realize that $10,000 loss. You can't write off all $10,000 as a loss, but what you can do is you can write off $3,000 as a loss. And you could do so, and you spread it, $3,000 a year. So that means the first year, $3,000, second year, $3,000, third year, $3,000, and then the last year, $1,000. And that utilizes all $10,000 of the loss. So that's if you had losses. And if you guys remember, the stock market at the beginning of this year was going down. So if anybody here has investments, have stocks that are in non-qualified assets, if you sell those for a loss, you realize your loss, and then you can use those losses to offset gains or income. Fantastic. Tax tip number 4, Claim your side hobby or side hustle as a business. I know some people, they make money on the side doing whatever small things it is. I know some people, they drive Uber. Some people, they do some people's laundry. Some people have a tutoring job. Some people, they buy and sell credit card points, credit card miles. I know some people, they buy and sell tickets. They're like ticket brokers. So people have side hustles, and those side hustles are making you money. But it could be that you have expenses that are related to side hustles, and you're not even claiming those expenses as a business expense. So if you have a side hustle making business, a side hustle making money, excuse me, well, the same way that side hustle is making you income, it probably has some expenses. Now, whether you have a lot of expenses, a little, that's going to depend upon the business that you're in. But if you have a side business that is making you money, okay, the same way it's making you money, you're going to have to pay the tax on the income. Let's at least lower the tax on the income by writing off any expenses or writing off those losses. Okay. And by the way, there are ways that you could structure your business, your side business, where you could minimize your self-employment taxes as well. For those who have been to my classes, you probably remember a conversation about S Corps or Subchapter S. Even though you have your own business, you could structure your business as a corporation, specifically as an S corporation. And when you have an S corporation, you're going to be paying yourself in one of two ways. You're going to be paying yourself either as the big boss, the owner of the company, or you can be paying yourself as the best employee you've ever had. Now, here's the thing. The money that you pay yourself as the best employee, you're going to owe employment tax, both the employer and the employee portion. So that's about, what is that, 15.3% taxation? That's crazy. However, the money that you pay yourself as the big boss, you could avoid the self-employment tax on that. So everybody here should, if you have a side hustle, you or your spouse, you should definitely be exploring how to claim the expenses and write off those expenses, and maybe even structure your business as an S corp to get those to avoid the employment tax. One more tax tip. Not that you guys really needed me to push you for this, but you can always give charity. And it's beautiful to see that there are many of my clients charitable people. It's beautiful, beautiful to see. Some people are even charitable to a point where it threatens their financial plan. It's beautiful to see. Although I will tell you that when I have a client that is so charitable to the point where it's detrimental to their own plan, I sometimes tell them to stop their charity or to at least scale back on their charity. I feel bad doing that because I know how dear it is to some people. But for those who are able to give charity, there are ways that you could give charity and lowers your taxable income. Now, I know some clients, they have their RMDs, the required minimum distributions, and they say to me, Stefan, I don't need the RMD, but they're forcing me to take it, and I'd rather just give it to charity. And if you go to what's called a qualified charitable distribution, a QCD, if you have your RMD sent directly over to the charitable distribution, to the charitable institution, excuse me, you will not owe taxes on that RMD. Okay? Fantastic. It's not realized income for you at all. Beautiful, beautiful, beautiful. So this way you don't have to itemize your deductions and anything like that. You don't have to claim charity as an itemized deduction. No. If it goes straight from your RMD to the charitable institution, no taxes on that. Also, there are ways you could contribute taxes to either donor advised funds that lower your taxes now, or charitable trusts. And there are some charitable trusts that will lower your taxes now, and charitable trusts will lower your taxes in the future. But these are just some tax tips for you guys to lower your tax liability this year. But again, let me just remind you, as wonderful as it is to lower your taxes this year, take a step back and realize that you have many years ahead of you. And I'd like for you not just to measure the tax benefits of lowering your taxes this year, but I want you to compare those to what would it be if I lowered my taxes in the future? What am I giving away by lowering my taxes now? And there are things you're giving away, and that was that slide that I brought down to you guys earlier. I hope I'm making sense on all this, and I want to take some questions. I do see that we have some questions in the chat box. However, before I go through those questions, I just want to point you guys to the link in the sidebar. Okay, so if you have that link in that sidebar, everybody here, if you could grab that link. In fact, I'm going to paste the link in the chat box for you guys to have. Okay, so here it comes. I'm gonna paste the link in the chat box. Here it comes in the chat box. Here it comes. 1, 2, 3, and bang! There you go. Fantastic, fantastic, fantastic. Okay, so whoever has the ability, if you could click on that link, it'll take you to a web form, request your meeting. I'd love to connect with you offline. Okay, so let's go through the questions that are in the chat box. I see Jessica has a question. Are HSA lost if we leave federal service? No, HSAs are not lost. And Robin has a similar question. Are HSAs available to retirees? Yes, they are available to retirees. HSAs are very, very powerful instruments. Rick, but wouldn't Part B be recommended if there are things that FEHB won't cover and Part B would pick up the difference? So, Rick, yeah, it is possible that there's some things that Medicare Part B covers that your FEHB plan does not cover, but did you ever explore a different FEHB plan? Because a different FEHB plan may cover that. And also, Rick, if a person is getting Part B for the things that FEHB does not cover, how often are they benefiting from those things? Is this something that they're going to be benefiting from every single year? Or is this the type of thing that they're only going to be benefiting from, like 25 years in the future? Because if you're only going to be benefiting from 25 years in the future, that means you're going to be spending the next 25 years paying inflated Medicare premiums. And those Medicare premiums are only going to go up when those RMDs kick in and they force your income higher. Okay. Fantastic. I hope I'm making sense in this. I really hope I'm making sense in this. Anyhow, I would encourage you guys to stay connected. Don't be strangers. If you see that button in the sidebar on the side, just click on that button. Just click on that button, and that will take you to a meeting request form and request your meeting. This way we could get you in. I know federal employees are under a lot of pressure this year. A lot of pressure. Some people have deadlines. Some people, they just don't like the new work environment, the new attitude, and I totally hear that. And I'm fielding I'm fielding questions from federal employees all day, all week. So I definitely talk this language. If anybody here needs any help when it comes to federal benefits, or when it comes to retirement, or when it comes to anything that's related to your personal finance, by all means, reach out to me, and I'd be happy to get you moving. It was amazing, amazing hanging out with you guys. Really, really appreciate that. And I look forward to connecting with you in the future. Wishing you all the best, everybody.